Personal finance practice problem using OneNote. Balance sheet accounts and accounting equation problem number 2. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 2120 Balance Sheet Accounts and Accounting Equation Prob 2 tab. Also note, when using OneNote, take a look at the Immersive Reader. Our presentations will also be in the text area. Same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're going to be looking at the balance sheet, expanding a little bit on it, noting that as we go through these practice problems, we're looking at these financial statements and adding a little bit more detail as we go. Also realize that in practice, your question will be, how do you want to compile your financial statements? How do you want to compile your past history? You can do so on a transaction by transaction basis, possibly using something like accounting software like a QuickBooks or a OneNote or Wave accounting software or something like that, which will take, you can imagine kind of like your banking detailed transactions, record them transaction by transaction, building the financial statements, both balance sheet and income statement, as you enter the transactions. Or you could think about trying to take the ending balance and piecing together your information periodically, possibly using software that basically takes the ending balances from your financial institutions, like the ending balance of your checking accounts, savings accounts, investments, compiling them together. But when you do that, it's a little bit more difficult to then get the detail of the transactions for something like the performance, like the income statement accounts. So that's going to be your trade-off when you're thinking about compiling these financial statements. Now, note also that the balance sheet represents where we stand as of a point in time, as opposed to the income statement being our performance data. You can tie that in essence, to the accounting equation, which is assets equal liabilities plus either equity or what we're going to call here net worth on the individual side versus the business side, which you can also calculate, which is what we'll use more often here, the assets minus liabilities equaling the net worth. This first equation, liked by accountants due to the fact that it shows two sides of, in essence, the same coin, what we own, assets, and then who has claim to those assets, either third party, the bank, liabilities or something, or the us as the net worth or owners. That's why it would be called owner's equity generally in a sole proprietorship or something like that. Or down here, you've got basically the emphasis on our net worth, which is like the bottom line kind of number, which makes sense oftentimes when we're looking at it from a finance perspective. Okay, so now we're going to take a little bit more detail in terms of our accounts and group them into our standard account categories as we put them into basically a balance sheet. So the first thing I want to do is go through our list of accounts up top. I'm going to color code them, assets being green, liabilities orange, and then any equity would be on the blue side of things. So we'll just basically go through that list of accounts. If we had a money market account, that would be a fairly liquid asset. So I would put that up in the liquid asset areas. If it was a business, you might call it a current asset. So current asset and liquid asset are going to be two terms that you might use kind of somewhat interchangeably depending on which you're more comfortable with using. The mortgage, I'm assuming this is our debt, the mortgage that we owe, liability on the home mortgage. That would clearly be a liability, and it would also be something that hopefully is not current, or at least the major component of it is not current. When we compile our balance sheet, this is one of those areas that becomes confusing because we want to look at our liabilities, breaking them out between the current and long-term portion. Something like a mortgage is clearly long-term and that we're going to have it for a long period of time, but we do have a current portion to it, the amount that's going to be due within a year. So again, when you compile your financial statements, the question is, how do you want to deal with this? If you're using something like a QuickBooks, entering data as you go, then you'll usually put this basically in a long-term liability and then possibly make adjusting entries periodically to show the short-term portion of it, which is important because you want to know what your immediate 12-month out close range liabilities are so you can compare them to your liquid assets to see if you have the cash flow in order to cover those. If you're compiling this stuff from a period by period basis, then every period you compile it, you're going to want to kind of think about what the next 12 months will be in terms of cash flow or loan amount that will be owed. And then we got the retirement account. So a retirement account, I would assume a retirement account usually being for most people like a 401k or an IRA, which means that you have money usually in stocks and or bonds, mutual funds oftentimes, but under the umbrella of an IRA or 401k. That umbrella means you can't take it out without being penalized, because the reason you put it into that little umbrella amount is because you got a tax benefit for doing so. And the trade-off is you can't take it out unless we you were told you're allowed to take it out now because you got this. That's what the trade-off was for the tax benefit. So that means it's not going to be a liquid asset then, because it's something that is locked in some way. So we got to put it into a long-term type of asset, which we might categorize as non-liquid assets or other current assets. So I'm going to put it into other current. Notice if it wasn't in a retirement account, meaning not in a 401k plan or something like that, and you had investments in something like stocks and bonds that you just had in investments, they're not restricted in that way, then you might put them in, say, liquid assets, or have another account called investments that are not restricted and whatnot. So I would typically have those two things separated, because if you're not restricted by a retirement account, then you can get access to that money without being at least penalized. You might have capital gains taxes on it, but you could still, use it if you need to, generally without too much hassle. And then we got the medical bills. Now, if I'm talking about medical bills, that means I'm talking about usually something that's an expense. So if I'm looking at basically the balance sheet here, medical bills doesn't really fit. So, right, that's something, okay, that's not on the balance sheet, that's on the income statement, so I'm not going to make it any color. And the next one we have is the credit card balance. Now, a credit card balance is something that would be due within the next year, typically. So something that we're going to have to pay off at least a portion of short term. So we're going to want to put that generally in short term. Now, you might only have to pay off a minimum balance of it. But remember, we want to pay off the credit. General rule is you'd like to pay off the credit card so that you're not subject to the higher rates. And if you're financing on a more long-term basis, then you might want to finance possibly with a mortgage if you can, because then that would allow you to possibly get a tax benefit for it, or use some other kind of financing for long-term financing, some other kind of loan, typically, because you might get better rates and better terms for that. Okay, so then if we construct our balance sheet, we're now just going to construct our balance sheet. I'm going to make it a gaudy, colorful balance sheet here so that we can go with our color schemes, assets in green, liabilities in orange. We're going to do our standard kind of breakout, having our liquid assets, which you might also think of as the current assets. Now we have the category, and now we're going to apply the current assets into that category. Also note the structure as we build these. If you get the common structure of these, then it's a lot easier to read longer, complicated reports, which otherwise would make your eyes roll over. And it's also easier to construct reports in such a way that they will be easier for other people to read, and therefore nicer for you to demonstrate them to other people. So we're going to put the liquid assets, which are kind of similar to current assets, meaning we can spend them fairly soon. Therefore, we want to be able to compare the liquid assets to the current liabilities to see if we can cover the current liabilities with our liquid assets. So we have a colon indicating that that's going to be a subcategory, and then we're going to list our liquid assets typically by liquidity, meaning the most liquid assets up top. So even though, for example, the checking account might have less money in it than, say, the savings account or something like that, we want the checking account first generally, because that's the easiest thing for us to access. So we're going to say checking account. That was up top. We got the 1,100. And then we have the money market account, which is also more like a savings account here, but something that we could typically access fairly easily. So if it's something I'm not restricted from getting to, then we're typically going to put that in our liquid assets. Now we're going to underline that. Notice we indented that to indicate also it's a subcategory. We put that into the inner column indicating it's a subcategory, and then we're going to sum it up total liquid assets. Notice we had liquid assets up top and then total liquid assets indented 2 times, and also in the outer column, the 3,500 plus the 1,100, giving us the 4,600 on the liquid assets. Then we have the non-liquid assets. Note that this categorization, you might call it different. You might, come up with different categorizations on the personal side. Notice on the business side of things, you would usually have current assets, and then you would have, say, non-current assets, non-kind of liquid assets, and then you'd have basically property, plant, and equipment, things like buildings and equipment and whatnot. Here, I would have a general same kind of thing. The non-liquid assets might be things like your investment assets, meaning your retirement plans. So your non-liquid assets might be things that your long-term savings kind of things, the type of accounts that you have locked away that might be, I would think, more financial type of accounts, things that you're hoping that will grow over time, as opposed to then property, plant, and equipment, or what we might call household goods, which you may still call property, plant, and equipment, things that would be possibly depreciable assets normally for a business. The big one being the home, which is also the unusual one, because the home is something that we hope appreciates in value, as opposed to almost every other thing that we have, like a couch or a TV or whatever, which actually the cars, they depreciate in value. They usually go down in value. That's why they're depreciable type of assets. So here I'm going to put the non-liquid assets, and I'm basically thinking investment type of assets, which I'm not going to touch either because I can't, because they're under the umbrella of a retirement account. And if I do, I'll be penalized if I don't wait until I retire to take them out, or because I simply don't want to take them out because I want to leave them in for retirement and not touch them. So I'm going to put them down here as the type of things that I'm not going to be using unless an emergency happens to pay off my current liabilities. And then that's the only one we have. So I'm going to have the total non-liquid assets in the outer column, following our same convention of having a colon, the indentation, and then the total on the right side. Note that you might say this is kind of redundant since I only have one account. I'm not really totaling anything or summing anything up because I only have one number. You can represent this by simply putting this number in the outer column. That's what's often done so that you don't have this kind of redundancy. But if you're redundant and you have a total that down here and you follow the convention, that could actually be easier to read, even though it makes a longer report. So under the normal convention, you will often see, and you might want to do, just take this number if you only have one account and put it on the right instead of putting it here and then having a subtotal. And then that'll give us our total assets summing up on the right side. Notice when I add things up on a section by section, we don't jump from column to column, meaning I'm not going to add up this 95,000 and then this 3,005 and this 1,001. No, I'm just going to add up one column at a time. If there are numbers above this number here, I'm just going to sum up this column, which is the 4,006 plus the 95,000 to give us the 99,600. And this, when I summed this one up, the 4,600, there was nothing above it. There was something to the upper left. Therefore, I summed just simply to the upper left. This one had nothing above it, just something to the upper left. So I'm only summing the upper left. I'm going to stop where the next underline is. I'm not going to jump from this column over to that 4,006, for example. Those are the general rules normally. Then we're going to go to the liabilities. These are things that we owe money in the future. We got the credit card balance. That was our short-term liability, something that's going to be due within the next year. And that is all we had. So we got the total current liabilities being the 720. Current liabilities is the same as the business term for personal and business. So current liabilities generally will be called current liabilities. It's an arbitrary number in that it's got a cutoff of 1 year, what we're going to be owing in essence in 1 year. You want to have that cutoff at some point so that you can compare your current liabilities to your liquid assets, because the liquid assets are the things you're going to be using in order to pay off the current liabilities. So you want to make sure that you have enough of the liquid assets to pay off, and realize that your goal isn't to have a ton of liquid assets or like a whole lot of liquid assets. You don't need your liquid assets to be huge, because if your liquid assets are a lot, then what you're doing is you're losing money on investments. Because if you have a lot in liquid assets, you would want to put them either into the retirement account or some other savings account that would hopefully be generating more money. That other savings account may not be under an umbrella of an IRA. You might put it into stocks and bonds or some other investment that was not locked by an IRA, and you might still have it in kind of liquid assets up top, similar to like a money market account might be here. So you might have some pretty good access to it, although more restricted than the checking account. But in any case, you want to, so the point is that your goal isn't to have a whole lot of cash, in other words, because cash is not generating revenue. Your goal is to have enough cash to cover the current liabilities, and then have all your other money that you can invested in some way, not solely in accounts that are going to maximize or possibly give you the greatest return because that'll maximize risk, but in some kind of diversified way that give you some kind of return, right? Even if I put my checking account money, some of it into a savings account, I'm going to make a little bit of interest. Right now, it's quite small, but if interest inflation goes up, then it'll be larger. But I want to put it somewhere where I'm getting a little bit of return because I don't need it to be paying off my current liabilities. Therefore, I want it, somewhere where it's going to be making money, but possibly be accessible in the event that I need quick cash for an emergency. Okay, so long-term liabilities, we have the mortgage here. So remember, the mortgage is something that usually is paid monthly. So clearly it will be long-term, but you still got that short-term portion to it. So although I put it down here in long-term, and when you do if you did this in QuickBooks or something like that, if you were entering the data as you go, you probably would record the mortgage in a long-term liability, but you still got to realize that there's going to be short-term components to it when you do your comparison to think about your current liabilities or your liquid assets versus your current liabilities. And you can do that with actually a physical journal entry. So you might have something up here periodically saying, hey, this is the current portion of the mortgage. This is my long-term portion. The current portion is going to be due in the next year. I want to make sure I have the liquid assets to cover that. The long-term are going to be due after that. So that's not an immediate problem in terms of my liquidity that I'm dealing with, right? The first thing I got to deal with is my immediate cash flow. Can I cover my immediate, bills? And then I can think about more of my long-term as we go. So if you're doing this in QuickBooks or something like that, some kind of thing where you're tracking the transactions as you go, that becomes a problem because now you have to break these two things out. And when you deal with interest versus principal, it gets a little bit confusing to deal with. You got accrual concepts that are coming into play again. And we do have a lot of courses on bookkeeping if you want to look into that in more detail. If you're just compiling this from period to period, then the software that compiles just the ending balances, just taking this from your financial institution, will probably label it as just a long-term or as mortgage. And once again, you just then have to consider or just realize that you want to make sure that you're looking at the current portion when you're thinking about things like comparing your current liquidity. And then we're going to say that's the total long-term liabilities. So same kind of function. We got the colon, indented the mortgage, then we put it to the outer column. Also note with these two, there was only one account per category. So we don't really need this convention of having another subtotal. We could have just taken this number and put it into the outer column directly so we don't have this redundant of the same number for something that's not really being added. So either way would be fine. And then we could sum up the total liabilities, which would simply be the outer column this time. So now we're just adding one column at a time. There's something above this number. Therefore, we're going to be adding this column. I'm not going to go up to the 99.6 because that's been stopped by the double underline over here. So we're going to take the 720 plus the 170,000. That gives us the 177.20. And then we can say, okay, if my assets are the 99,600, then I owe 177.20. That gives us a difference of the 71,120. Now note that 71,120 means I got like a negative net worth, which isn't exactly correct because I see here I have a mortgage, but I don't have anything up top for the home, which would be a personal asset. So and that's quite actually fairly common to have something like this be the case if you're using software that's basically pulling the ending balances from your financial institutions. Meaning if you use software that connects to your financial institutions, that pulls in the ending balance from the financial institutions, they're going to have the ending balance for things like your checking account, your money market, your retirement, which is basically a financial institution, most likely for stocks and bonds, credit card statements, and your mortgage. They're not going to have your home balance on there because that's not something that can be judged by the financial institution as easily, right? Because the home is something that you purchased in the past, and the only way to get the current value of the home is to get an appraisal on the home, which you can approximate with online, software. You can approximate the appraisal of the home, look at similar homes in the area and that kind of thing. But just realize that when you're looking at if you're trying to just put your balance sheet together quickly, you can use software that will kind of pull the ending balances in pretty quickly, but it will only pull the financial balance data in. And then you would have to estimate the things that would be the non-financial data, including your home and any other goods like the car, like the sofa, like the the TV and that kind of stuff. Also realize that as you do that, that may or may not be as important for you to do depending on what you're using this form for. Meaning, if I'm trying to use this form just for my future finances to budget and whatnot, then I'm not as concerned even with the home. The home is important because it's a huge asset in terms of my personal finances typically, but it's not something that I'm going to be I'm planning on living in the home for the next 30 years. I'm not. If that's the case, whatever happens in the market as the home goes up and down doesn't really impact me too much. It might be part of my retirement plan if I plan on dipping into the home value for my retirement. So I'd want to take that into consideration. But again, it's not something that is concerning me too much on basically the day-to-day issues when I'm thinking about my personal finances and my kind of long-term planning to some degree, although the home is somewhat of an exception. When you think about things like a couch or the things like your TV or your car, that again are things that if you put on the balance sheet, you have no way of checking actually what their actual value is. That's an easy way, meaning these financial institutions will tell you the financial assets, what their current value is based on the market price as of that point in time. With your car, it's something that we would call a depreciable assets. Most other assets besides your home would generally be depreciable assets, meaning if you put them on the books, they're going to go down over time in terms of value. And so to accurately record them, you would have to actually record the decrease in value over time. And also, they're not things that you're going to be using. So they may not be that important depending on how you're using your financial statements to include them, because they might not be changing your decisions because you already bought them and you're not going to sell them typically or generally, which again, the home is kind of an exception because it could play into your retirement plan. So on those property, plant, and equipment, keep those in mind. If you're doing this financial statement to get a loan or something like that, then it might be worthwhile. Of course, you might want to talk to the bank and say, well, how detailed do I need to get on the personal side? Obviously, the home could be important. Any other kind of collateral that you'd put on there could be important in that situation. So it kind of depends on what you're compiling your assets for. But bottom line, just realize that the financial data you might actually be able to get fairly quickly if you, even by not using accounting software like QuickBooks, by using other software which will pull in not the transactional detail, or that's not the primary purpose of it, that kind of software, as it is with QuickBooks generally, or some other accounting software. The primary goal there will be to pull in the ending balances, giving you a nice quick balance sheet, but it cannot update things that are not financial institutions, which are not being determined by the market. Things like stocks, bonds, your checking account, and whatnot, which isn't determined by the market, but the financial institution knows how much money you have in those senses as well. So also note that this net worth is kind of like the equity side. So remember, we got the assets minus the liabilities gives us the net worth. If we were doing this from an accounting standpoint, in like a QuickBooks or something like that, entering transactions, and I was to compare my net worth, for example, this period to last month, then the next question is, well, how did I get from last month to this month? The difference would be the income statement. That's your timing statement that shows the performance. And when you do the budgeting from this month to next month, then you have the income statement. You're thinking, how much income am I going to make versus the expenses, the cash inflow versus the cash outflow. And for that, it's more difficult to do with software that's designed just to pick up the ending balances from the financial data, something like a QuickBooks or something, which takes more work, but will give you more data for your performance numbers generally if you're entering transactions in an accounting type of fashion. Otherwise, you'd have to kind of compile your income statement and whatnot so that you can better do your budgeting, your budget kind of scenarios in some way if you're using software that basically just compiles the ending numbers, the balance sheet type of numbers. Then you'd have to do a little bit more work to compile and put together your income statements to whatever degree you think necessary for your personal planning and personal needs.